Hello, welcome back to Short View from the Financial Times. The past couple of months have seen a major crash in asset prices in developed markets, with the infection apparently coming from emerging markets, and in particular China, possibly via commodity prices. We've seen a bit of stabilisation in the past few days in emerging markets, commodity prices and lots of China-exposed assets. But to discuss the much bigger picture and just how bad this could get, I have with me Russell Napier, author of Anatomy of the Bear and founder of research platform ERIC. Russell, I'll bring up a chart here. If you have a look at this, this shows just how bad things have been for emerging market equities in blue, and against that, commodity prices in red. We can see the two have moved closely together. There's a broad view that cheaper commodities are a good thing for developed markets, which tend to be consumers of things like oil and, of course, of finished goods using things like steel. Should we really be worried about this in developed markets? Is this not a good thing for us?
Yeah, it's certainly one of the big debates. Is there a good deflation and is there a bad deflation? The good deflation would be the one you've outlined, where we could have a situation where, let's take an economy like the United States, where corporate cash flow holds up, household cash flow holds up, and the price of goods come down. That would be, I think, we'd define as a good deflation.
We can buy more stuff.
We can buy more stuff. The bad one would be where one of those cash flows comes down. Now, in a sealed system, of course, it's highly likely that cash flows would be coming down if we had deflation, that someone's cash flows would be falling.
Sure.
So if we go to the United States and we ask the question, is there any evidence that these price changes we see in the world are impacting either household or corporate cash flow? And the answer for the corporate is yes. Now, most obviously in the energy sector.
Yeah.
America has a significant energy sector, and that's falling onto the levels of investment and employment in that sector. But there is another one as well, where there is an impact, and that is through the exchange rate. Mm-hmm. And in dollar terms, cash flows in America are being hit by the higher exchange rate. So it's early days, but at the margin, there's some evidence this impact of emerging markets, which is pushing down the energy prices, which is pushing up the dollar, is beginning to impact corporate cash flow. At this stage, corporate cash flow is highly directed to buying back its own equity, so it falls upon the equity market. But in the longer run, it would potentially fall upon the jobs market, because the corporations, if its cash flow was impinged, would be less likely to expand and hire people. So early, but some early signs it's a bad deflation, not a good deflation.
Well, let's have a look at just what people are expecting for deflation. This is the blue line, is the five-year expectation, so inflation starting in 5 years' time. Now, that ought to strip out effects of falling commodity prices, but put against that the oil price, and it seems pretty clear that people are quite sensitive to what's going on with commodity prices now. Is that evidence that we should just ignore this as being irrelevant, or is this evidence that actually falling commodity prices are deflationary and really bad news for the long run?
Sure. Let's talk about what Ben Bernanke thinks about this, because he had a very strong view on this, and what he said is this is his famous helicopter speech from November 2002. He said the worst scenario the Federal Reserve could find itself in would be with interest rates at the zero bound and then deflation, because interest rates would be real rates of interest would be going up. Now, he said, and this is sort of back to where we started, he said that would impinge upon investment, it would impinge upon residential property investment and economic activity. So this is important, because this is real rates of interest. We're looking at the 5-year here, and as you can see, there's 100 basis points off that in just over a year. That's, given that we're at the zero bound, that's a change in real rates of interest. Now, you either believe that real rates of interest do impact economic decision making, or you don't. If you'd had the 1 year up here, it's much more dramatic, it's much more volatile. Yeah. And it's actually showing this morning minus 1.6% over the next 12 months. So that takes us to the sort of second part of Bernanke's speech. If the price of goods comes down, do we buy more or less? And the last time this happened in the States was in the late 1990s, and the answer was more. I think this time the answer is less. So that a falling price may postpone consumption, and that's to do with the aging of the baby boom generation. They may not just be as pro-consumption as they were. So is this relevant or irrelevant? If it's just reflecting the oil price, it's irrelevant. If it begins to impact how real economic actors behave, then it becomes highly relevant, and I think that is probably going to happen.
Okay, and if we bring up the next chart, we've got here junk bond spreads over treasuries. So this is the extra yield that people demand in basis points to buy junk bonds, and in red is the broad US index, and in blue is just the energy sector. You were saying earlier about energy being problematic. That's obvious. There has been a rise in the broad risk premium there for junk bonds, but is that saying there's an infection here, people, or just normal levels of worry?
Well, I think it's worthwhile pointing out that at the bottom here we were back to yields really associated with the early 1960s, so a very long-term low. But I think this is the best market we can have that looks solely at corporate cash flow. I mean, you're lending the corporate money. How much you charge it will depend on your views on its stability, robustness of its corporate cash flow. So when that begins to rise, let's just look at the normal one, not the energy one, that's pretty obvious. You can see that that is telling you that people are less confident about the robustness of corporate cash flow than they used to be from a very, very low base. Yeah. So I think that is another part of that little bit of evidence that this is the bad deflation, that it's impacting corporate cash flows. The reason that I think this is really important is I think we know as of this morning that the People's Bank of China sold $180 billion worth of their reserves. And we have to assume that a large proportion of that was treasuries, but treasury yields didn't go up. So somebody in the system bought those treasuries. To me, it's fairly reasonable that the private sector savings system of America liquidated its corporate bond portfolio to buy those treasuries. Unless they were sitting in deposits, they had to sell something. Now, if that continues, that's another infection from emerging markets. The first one we've talked about is potentially deflation, how that might change economic actors in the United States. But the second one is that this might be caused by the liquidation of the treasury portfolio, not just by the PBOC. As we know, there are other central bankers doing the same. It's a feedback loop. This also has impacts on corporate cash flow if the cost of corporate borrowing is going up. And that's the mechanism which links emerging markets back into the developed market.
So how bad does this get? Obviously, we saw disaster 2008 after Lehman collapsed. 2011, the US government came close to default, and it was far less bad. And we obviously also had the Eurozone crisis at the same time. Now we've got just an emerging market crisis for the moment, at least. This is still saying not even as bad, well, it's basically at 2012 levels, certainly not as bad as 2011, and nowhere even comparable to 2008. If you're right and this is the first sign of an incipient bear market, how bad does that get, and what happens to something like the S&P? Okay,
well, it'd be very difficult to forecast that things would be as bad as 2008, 2009. I mean, that was the virtual collapse of the entire US financial system. I don't believe we'll see that again in our lifetimes. I'm not saying we won't see problems in that system, questions about the system, liquidity issues for the system perhaps, but that particular episode unlikely. So in that view, that level is highly unlikely to be replicated. But it will be a higher level. US corporate profits as a percentage of GDP were until very recently at an all-time high. It is a very mean reverting series, and corporate profits and corporate cash flow are significantly linked, is the best way to put it. So if they just start reverting to mean, then this should go back more towards its average, which is near where that energy one is today, without getting to the level of 2009, 2010. So the question then is just what are levels of gearing in the system? And does the fact that bond yields are going up begin to affect real economic activity? And I think it will affect real economic activity.
Okay, thank you very much, Russell. So there you have it. Very bearish look there, but not as bad as 2008.